Nitin Raheja joining us from Julius Baer to talk to us about the fundamentals of the market. But Nitin, before I talk about markets, let me ask you, are you working tomorrow as the rest of us, given that special session that NSE is holding?
The operations people. So yes, for that limited time, we are working.
Call me a sadist, but I'm happy to hear that there are other people working as well. Let me put those details on board and quickly get Snehi into the conversation. Snehi, fill us in. What are the important timelines that we should watch out for tomorrow? What time does the trading actually start? What's the break like?
Well, yes, both the exchanges, the BSE and NSE, are going to conduct a live special session tomorrow for the FNO equity trading segment. Let's understand why this is being done in the first place, and this is as per a SEBI mandate. The exchanges are required to perform a switchover from their regular platform to their disaster recovery or their disaster management platform tomorrow as part of their business continuity plan. So come tomorrow, BSE and NSE will orchestrate an intraday switchover to their respective disaster management sites, and both exchanges will conduct two special sessions tomorrow. So the trading tomorrow will be done in two special segments. The first one, the pre-open will begin at 9 a.m., close at 9:15, and the session will start from 9:15 to 10 a.m. For the second session, the pre-open will begin at 11:15, close at 11:30 a.m., and the trading session will commence from 11:30 a.m. until 12:30 p.m. tomorrow. Now let's understand why this is being done and what's so special about this trading session tomorrow. The first thing to note is that usually when stocks are traded in the FNO segment, they do not have a circuit limit. But in tomorrow's trading session, stocks in the FNO segment and futures and options will have a circuit limit of 5%. That's one important factor to note. Along with this, also remember that the stocks that have a regular 2% circuit filter will continue to have that tomorrow as well. Another key thing to note tomorrow is that the securities that you purchase in today's trading session cannot be sold off in the special session tomorrow, and the ones that you purchase in tomorrow's session cannot be squared off on Monday. So well, watch out for tomorrow's live trading session.
Well, yes, unfortunately, it's a Saturday, but it's going to be a working Saturday. But today as well, there are a whole host of earnings lined up post the market close, and one such earning is HUL as well. Wanted your take, Nitin, not just about HUL, but the entire FMCG basket, because for bulk of last year, there was this, underperformance from the sector, though in the last couple of months, we had seen a bit of an uptick. What's your take? Is the worst over? That entire rural demand has bottomed out now?
Well, anecdotally, at least when you talk about the two-wheeler people, two-wheeler companies, sorry, they're talking about a revival that is showing up, at least the initial signs of revival. So I think while we haven't had full-fledged data that is out, which sort of were to support the fact that there is a revival, but clearly there are early signs of a revival in the rural economy. And if that were to subsist, and also, as we generally get into an election, there is some amount of spending that takes place in the rural economy. It's more to do with infrastructure. So yes, you should see some signs happening there. And the fact that inflation in some commodities has been benign, while food is yet a little bit of a sticky item, you should see some of these FMCG players sort of show up a little better results.
A little better, even if not a whole lot better, but there will be some improvement as far as FMCG earnings are concerned. But separately, what do you make, Nitin, of the private banking results that we have seen so far? Is it making you change your thesis on any of the names, or you're holding your ground when it comes to the private banking space?
So, it was our view for some time that we had seen peak net interest margins for these banks over the last 2 quarters ago. Now, I think what you're seeing today is also a further challenge which has come up in terms of deposit mobilization, which could impinge on credit growth as we go ahead. So, but having said that, I think a lot of it is already in the price if you look at valuations of these banks. So we continue to remain positive on the whole private banking space. We think valuations are looking attractive, more so because there has been such amount of selling that has taken place on part of FPIs. And if I have to scan around today, relative to growth, even if you account for the fact that credit growth could slow down in the short term. If you have to account for that and look at valuation, I think it's all there in the price.
Okay, so that's an important statement. There is, even if you factor in the weakness, it's now in the price. So probably some of these stocks are reaching that buy zone. At least that is what the some of the RSI indicators are also indicating, that HDFC Bank, for instance, had gone into the oversold territory as well. Welcome back. Well, Dixon Tech is seeing a bit of a breakdown from head and shoulder chart pattern, has hit a 1-month low on an intraday basis. Of course, the news of the DRI making some surveys that its facilities or the subsidiaries facilities not helping its case down in the trading session. The other one is Manappuram Finance. It's seen quite a bit of breakout from 6-session consolidation. It's up 5% in the trading session today, so watching out for that. IndusInd, of course, has seen a breakdown from the upward support trend line. It's been declining for 4 sessions, and today a bit of the asset quality concerns is weighing on that counter. You also have IRFC, which has been advancing for 3 months on the trot. It's gained 60% in a matter of a year. It's trading above all its key moving averages, has hit a record high on an intraday basis, and of course the market capitalization has surpassed a whopping 2 lakh crore rupees for IRFC. So that's the kind of gain that we're seeing on that counter. But the big one that everyone wants to talk about today is, of course, Reliance Industries. It will come out with its earnings. What we should expect is something that Somit is joining us to tell us more about. Hi, Somit.
Well, for Reliance Industries, if you see, it is expected to be a muted set of numbers. Revenues are expected to be high by around 2%, but on the EBITDA front, we can see a decline of around 1.7%. Margins are expected to contract by nearly 70 basis points, while net profit is expected to be low by around 3%. Now, if you see segment-wise performance, it is the O2C segment, which is expected to report a decimal sequential performance, 12% drop, which will lead to an entire EBITDA dropping by around 1.7%. Apart from that is the retail segment, which will see a healthy growth of around 7%, while the gas exploration segment is also expected to report an 8% growth on a sequential basis. Now, the reason why O2C segment is expected to report a weak performance is because of lower throughput and lower spreads. Now, lower spreads are because petrochemical margins were lower and throughput were lower because there was a planned shutdown in the third quarter of FY23. Retail segment, FY24, retail segment would benefit on the back of higher footfalls, store expansion and operating leverage, while the gas exploration segment is expected to benefit owing to higher gas production and because of lower costs that we had seen in the third quarter of FY24. To sum it up, it's the O2C segment that would report a decimal performance. Apart from that, all the other segments are expected to report a sequential growth.
And even for Jio, right, you are expecting a revenue jump up of 2.7%. The net profit is expected to jump up by 2.7%. That's because the ARPU is expected at 183 on account of the higher subscriber addition. So that's the expectation from Jio as well. But shifting focus back to what we were discussing as well, Nitin, and that's about the public sector entities, the kind of massive re-rating that we have seen last year, not just of the public sector banking stocks, but even the defense ones, the railway stocks, even the general insurance companies are now seeing a huge uptick. What's your view as to how one should visit the entire public sector entity space now?
Well, you'll have to look at it differently. So, for example, I think when you look at the public sector banks, I yet see, from a valuation perspective, there is enough scope in terms of a re-rating and growth that could take place. More of a growth rather than the re-rating part. But yes, clearly, when you look at, some of the defense sector space, I think a lot of it is getting valued based on order book. We forget that these kind of businesses tend to be lumpy, and from quarter to quarter there could be big variances. But right now there is this whole order book and the whole indigenization story that is being played out, and hence the sentiment has been extremely strong. So, but some of these valuations, if you ask me, are do not really leave too much margin for error. Railways. Again, you are seeing something similar take place in terms of the valuations, and so from a margin of safety perspective, I think it just seems to have discounted almost most of the upsides that are possible. And let's not forget, this is also because right now most of the economic growth has been driven by the infrastructure and capex spending being done by the government, which has been sort of doing most of the heavy weight lifting. You'll probably see some amount of lull in the next 3-6 months as we get into elections, and there is a cooling period. And post that, by the time ordering starts, it'll take some time. So you will see a 3-6 month lull as far as a lot of these capital goods and infrastructure companies are concerned, more specific to the government. But banks, clearly, yes, there is yet scope for an upside.
Still see scope in the banking public sector banks, that is on the upside. Interesting take. But let us go across to a technical guess and get some BTST ideas, and it is truly BTST because the trade is open tomorrow. Naresh, let me toss it to you. BTST, STBT, what do you have for us?
So two BTSTs on stocks which have hit new 52-week highs today. First, a buy on BPCL. Momentum continues. Stop loss at 478. Target price of 495. Second is a buy on Indian Hotels. Fresh new all-time highs here. Stop loss at 475. Target price of 495.
Hey, Kunal, what about you?
So two BTST calls. First is the one Apollo Hospital, something which we flagged off a couple of days back. Targets revised to 6,200. Stop loss to be kept at 59.50. And second would be a fresh buy on HDFC Life. This is a complete contra call. The stock is almost at its previous major swing lows at 600, 610 odd levels. So would suggest a buy with a contra expectation that this could be a major bottom in place for the stock. Buy with a target of 660. Stop loss at 600.
HDFC Life, that's the interesting one that Kunal is pointing out. But before I move forward, I need a chart check, Naresh, on a couple of these names. Z Entertainment, it's taking a further slide of 7%. Seems like that people are losing the patience on that one a bit. And the other one is Oracle Financial Services. We have been chatting about it, but it's up another 4% right now.
So Z is something which has been a mirage in terms of the way it has always reversed from that 290-300 mark. So would not look at it. Would look at it only once the event is over, or if the stock prices crosses 290-300. On the lower end, 190-200 has been a major support zone ever since the last 2 years. So no major view. OFSS, I would say this is a time to book profits. For the first time, the stock is actually going into a derivative ban as well. So, and the stock has moved up 30% in one session. So time to take some profits off on OFSS.
Okay, so that's a take on a couple of these buzzers in the trading session. What else is happening in the market? Well, it's fairly quiet in the sense that not much has moved in the last 20-30 minutes as such. The index is around that 21,629 mark. IndusInd continues to slide. HDFC Bank is down another 1%. So if you were taking solace in the fact that ADR had ended in the green yesterday, well, there's not much to congratulate right now because the HDFC Bank stock continues to trend lower. There's a cut of around 1%. Let's also take stock of what HUL is doing ahead of its earnings. And quickly, let's go across to Vinny to get a sense as to what we should expect in the numbers because it's trading at the highest point just ahead of its earnings. Vinny, is the street expecting a lot more improvement in the numbers?
So absolutely, in terms of HUL's numbers for Q3 FY24, we're expecting a muted performance, nothing exciting on that front. In terms of the revenue growth, around 2% revenue growth is what we're expecting. Profits and around 8.7% growth, while margins, a slight bit of an expansion, 80 basis point expansion on a year-on-year basis. EBITDA margins are expected at 24% or approximately. Volume growth, like last year, we have seen, last quarter, I beg your pardon, we've seen in terms of the low single digit. That's what expected to continue this time as well. So 2 to 3% volume growth is what we're expecting from HUL. Now, let's not forget, the trends that we've seen in Q2, similar trends is likely to be seen in terms of the competition from local players, regional players. Where is that headed? That is expected to see an increase as well, is what the indication we are getting. So yes, that continues to be maybe a pain point in some segments for the company. Premium segment, that's expected to do better than the mass segment. And personal care performance, we're expecting that to be soft due to the delayed winters. Other than that, food and refreshment, low single-digit growth as headwinds were there in the nutrition portfolio. Let's not forget the retail milk prices. That's not seen a sharp cut down coming in. So in terms of Horlicks, we are not expecting any price drop in Horlicks so far as well. But let's keep
an account. You think any material announcement that one can expect? We lost that feed. We'll just get back to Nitin in a second from now. In the meantime, just looking at how the market is wrapping up for the day. While of course this week we've had a bit of a choppy ride, 1.5% lower thereabouts is where we are settling in at that 21,643 odd mark. Kunal, I know we'll have the same discussion tomorrow because remember, tomorrow is also a trading day. But how are we pegged for next week, given what we've seen with the market this week?
But this week is longer. Next week is going to be truncated. Don't forget the Friday holiday.
So fortunate for that. But one thing is very certain, that this market is not the same market what we had seen over the last 2-3 months because of the impairment which we've got after this correction in the large cap private sector banking names. So there's going to be a lot of hard work for many of the other large cap stocks to try and offset the losses from these large cap private sector banks which we've seen over the last 3-4 days. And if that's the case, then we may be seeing some bit of stability coming back into the indices. But if we keep on seeing some negative surprises and the price action for many of the stocks gets into a negative territory, sooner or later it's going to impact the index trends. So I think the best position or the best strategy over here is to have a slight light position size than maybe what one could probably have been taking in the entire end of 2023. I believe that it's a better strategy this time around, because to try and navigate such kind of uncertainty where it's very difficult to expect whether the stocks will open with a gap up or gap down post results, I think it's better to go with light positions.
Okay.